In just 3 years, central banks added more than 3,000 tons of gold to their reserves, a shift worth hundreds of billions of dollars at current prices. But the most important part of this story is not what they bought. It is where they wanted that gold to be when the next crisis hits. Because this was not a flashy market trade or a headline-grabbing bailout. It was a quiet movement of bars, vault keys, and legal control, from foreign storage back toward home soil. And once you understand why that happened, you start to see how global finance is really changing. For decades, the world's monetary system ran on trust in institutions, trust in reserve currencies, and trust that assets stored abroad would always remain accessible. Gold was still important, but mostly as a backup, a legacy reserve sitting quietly in London, New York, Hanukkah, Paris, or Zurich. Then geopolitics changed, and that old assumption no longer looked so safe. By 2024, gold had become the second largest global reserve asset at market prices, behind only the US dollar. That was not just because prices rose. It was because central banks kept buying, and because gold began to serve a new purpose in a world shaped by sanctions, trade conflict, and political fragmentation. And here is where the story takes a surprising turn. The big message was not simply buy more gold, it was control it directly. In the World Gold Council's 2025 survey, 95% of central banks expected global official gold reserves to rise, while 73% expected the share of US dollar holdings in global reserves to decline over the next 5 years. That shift became visible in real-world decisions. In 2024, when India's central bank moved a little more than 100 metric tons of gold from the United Kingdom to domestic vaults. At the end of March that year, the Reserve Bank of India held 822.10 tons of gold, with 408.31 tons already stored at home. Officially, the move was described as logistical and part of diversified storage. But even that careful language reveals the deeper point. If a central bank wants more gold under its own roof, it is thinking about access, sovereignty, and what happens if global systems become harder to rely on. Germany had already shown the world what this looks like on a larger scale. Years earlier, the Bundesbank accelerated plans to bring home gold from New York and Paris, moving 583 tons faster than scheduled and aiming to hold half of Germany's reserves in Frankfurt. The message was subtle, but unmistakable. In uncertain times, domestic possession matters. The German case is especially revealing because of its history. During the Cold War, 98% of Germany's gold was stored abroad, far from any possible Soviet advance. What once made sense as a security strategy eventually became a political vulnerability, especially when public trust in the euro and in Europe's long-term stability began to weaken. But here's what most people don't realize. Gold repatriation is not really about metal. It is about the legal chain of control over the ultimate reserve asset. The asset that does not depend on another government's promise, another central bank's balance sheet, or another country's sanctions regime. Foreign exchange reserves are mostly someone else's liabilities. They are treasury bonds, bank deposits, and when sovereign paper issued inside a political system. Gold is different. It is a reserve asset with no issuer, no maturity date, and no counterparty in the usual sense, which is exactly why central banks return to it when political risk rises. That difference became far more important after the freezing of state assets turned from theory into precedent. ECB research found that sanctions and geopolitical alignment now play a visible role in reserve behavior, and that 1 out of 4 emerging market and developing economy central banks cited sanctions concerns or expected changes in the international monetary system as reasons to hold gold. In other words, gold is not being accumulated only as an inflation hedge or crisis hedge. It is also being treated as jurisdiction-proof insurance. If a country worries that foreign-held reserves could one day become politically constrained, then moving gold home is no longer symbolic. It becomes operational planning, and this is where storage suddenly becomes a strategic issue. The World Gold Council found that the Bank of England remained the most popular vaulting location in 2025, used by 64% of respondents, but it also found a sharp rise in domestic storage, with 59% reporting some gold held at home, up from 41% a year earlier. That is a quiet but meaningful repositioning of the map. Why does this matter so much? Because in normal times, international custody is efficient. London and New York offer deep markets, trusted infrastructure, and the ability to swap or mobilize gold quickly when liquidity is needed. But crises are never judged by normal times, and they are judged by what happens when physical demand surges, legal access is questioned, or governments start thinking in terms of strategic leverage rather than market convenience. That is when a bar in your own vault can feel very different from a bar on a statement issued by someone else. What happened in London in early 2025 offered a rare glimpse into that reality. After tariff fears and price dislocations pulled huge quantities of bullion toward the United States, the minimum waiting time to load gold out of the Bank of England stretched to 4 weeks, far longer than the usual few days or 1 week. Suddenly, even the most established gold hub in the world looked less frictionless than many assumed. Over just 2 months, 12.2 million troy ounces of gold were delivered into COMEX-approved warehouses, lifting U.S. stocks by 70% to 29.8 million ounces. By March, Reuters reported that bullion worth $64.5 billion had been delivered to COMEX since late November, while gold stored in London vaults fell to 8,477 metric tons, a 5-year low. That was not a collapse of the system. It was something more useful for understanding the future. A stress test. When the market wanted physical metal in a hurry, central bank gold stored in London became part of the liquidity conversation, and bullion market participants rushed to borrow gold from official holders. This single detail changes everything. It reminds us that reserve assets are not just numbers on a central bank spreadsheet. They sit inside real vaults, move through real logistics networks, and become strategically important precisely when markets stop behaving normally. Historically, this should not be surprising, gold lost its formal role at the center of the monetary system after the collapse of Bretton Woods in 1971, and for years its importance appeared to fade as central banks relied more on foreign currency reserves. Yet the metal never disappeared from reserve management because it still offered something paper reserves could not: independence from any single state issuer. Then came the financial shocks of the modern era. The global financial crisis shook confidence in banks and leverage. The inflation surge of the early 2020s revived gold's role as a store of value. And after the geopolitical ruptures that followed Russia's full-scale invasion of Ukraine, gold demand from central banks surged to levels not seen since the Bretton Woods era. The numbers are striking. According to the World Gold Council, most central banks added 1,082 tons in 2022 and another 1,037 tons in 2023, while 2025 survey data showed that official institutions had accumulated more than 1,000 tons in each of the previous 3 years. This is not nostalgia for the gold standard. It is a modern reserve strategy built for a more fragmented world. What happened next shocked many analysts outside central banking. Gold was no longer just a defensive asset sitting quietly in the background. In 2024, central bank purchases accounted for more than 20% of global gold demand, compared with roughly 1/10 on average in the 2000s. That means the gold market is no longer being driven only by jewelry demand, fund flows, or retail fear. It is also being shaped by institutions that think in decades, not quarters. When central banks buy and reposition gold, they are expressing a view about systemic risk, not simply chasing performance. For governments, this has immediate consequences. A larger gold allocation can reduce reliance on dollar assets at the margin, strengthen confidence in national reserves, and provide politically neutral collateral in a more divided world. It does not mean the dollar is about to collapse, but it does mean more countries are building protection against a future in which financial access may depend on geopolitics as much as economics. For markets, the implications are just as important. The ECB noted that gold prices increasingly reflect geopolitical risk and policy uncertainty, while euro area gross notional exposure to gold derivatives reached €1 trillion in March 2025, up 58% since November 2024. In plain English, more money is now using gold as both a hedge and a signal. And for ordinary people, the message is subtle but powerful. When central banks that once trusted foreign custody begin increasing domestic storage, they are not preparing for an ordinary business cycle. They are preparing for a world in which resilience, access, and sovereignty matter more than they did during the age of easy globalization. So where does this go next? Most likely, London and New York will remain major gold hubs because they still offer unmatched liquidity and infrastructure. But the monopoly of trust those centers once enjoyed is being diluted, one shipment and one reserve decision at a time. If geopolitical tension stays high, central banks are likely to keep buying, and some will keep moving at least part of their gold closer to home. Not because they expect the old monetary system to vanish overnight, but because they no longer assume the old guarantees will always hold. That is a very different mindset from the one that shaped the reserve world after the Cold War. And that is the real reason they moved gold quietly. Not to make a dramatic statement, not to revive a gold standard, and not because bars in a vault generate headlines. They moved it because in the modern financial system, the most valuable asset is not just what you own. It is what you can still reach when the rules suddenly change. Because when nations start thinking this way, the story is no longer about gold alone. It is about a world losing confidence in frictionless trust and rebuilding power around assets that cannot be frozen, diluted, or denied. And that may be the clearest warning of all.